You're collecting Social Security, maybe taking money from your 401k, and you think you've got your retirement budget figured out. Then April comes around and, surprise, you owe the IRS $3,200 you didn't see coming. The IRS just released the 2026 tax brackets, and if you're between 62 and 75, 3 specific changes are going to hit your wallet hard. In the next 9 minutes, I'm showing you exactly what's changing, which bracket you're actually in, and the one move that could save you $4,000 next year. Here's why this matters right now. Every year, the IRS adjusts tax brackets for inflation. Sounds boring, right? But here's what's really happening. If your income is going up, even just from Social Security cost of living adjustments, you could get pushed into a higher tax bracket without realizing it. And here's the kicker. Retirees get hit differently than working people. You're juggling Social Security, required minimum distributions from your IRA, maybe a pension, part-time work. Each piece gets taxed differently. It's like trying to fill out a puzzle when someone keeps changing the picture on the box. Think of tax brackets like stairs. Every time your income goes up a step, you pay a little more. But here's what confuses everyone. You don't pay the higher rate on all your money. You only pay it on the money above that step. The IRS doesn't explain this. Your tax software doesn't make it clear. So people panic, thinking they'll lose money by earning more. That's not how it works, but I'm getting ahead of myself. The stakes? If you don't understand these new brackets, you could accidentally trigger taxes on your Social Security, blow past the Medicare surcharge threshold, or take IRA withdrawals that cost you way more than they should. Let's fix that right now. First, here's what actually changed for 2026. The IRS raised every tax bracket by about 2.8%. That's the inflation adjustment. For a single filer, the 12% bracket now goes up to $48,475. That's up from $47,150 in 2025. If you're married filing jointly, the 12% bracket now tops out at $96,950, up from $94,300. Now, here's what that means in English. Let's say you're single and your taxable income is $45,000. You're safely in the 12% bracket. You pay 10% on the first $11,925, then 12% on everything above that up to $45,000. Your friend has $50,000 in taxable income. She's in the 22% bracket, but only on the money above $48,475. So she pays 10% on the first chunk, 12% on the middle chunk, and 22% only on that last $1,525. Here's where people mess this up. They think, oh no, I'm in a 22% bracket. I'm paying 22% on everything. No, you're paying 22% on $1,525. That's an extra $153 compared to the 12% rate. Not the end of the world. Make sense so far? Good, because here's where it gets personal. If you're collecting Social Security, here's your danger zone. Social Security isn't automatically taxable. But once your combined income hits certain thresholds, the IRS starts taxing up to 85% of your benefits. Combined income means your adjusted gross income, plus tax-free interest, plus half your Social Security. If you're single and that total hits $25,000, boom, up to 50% of your Social Security gets taxed. Hit $34,000? Now up to 85% is taxable. For married couples, those numbers are $32,000 and $44,000. And here's the thing that drives me crazy. These thresholds haven't changed since 1983. 43 years. Everything else adjusts for inflation, but not this. So every year, more retirees get pushed over these lines just because of cost of living adjustments. Real example, you're married, filing jointly. You collect $36,000 in Social Security. Your spouse has a $25,000 pension. You pull $15,000 from your IRA. Your combined income? $18,000, half your Social Security, plus $25,000 plus $15,000. That's $58,000. You're way over the $44,000 threshold. Up to 85% of your Social Security, that's $30,600, is now taxable income. You thought you had $76,000 in income, but for tax purposes, you're looking at $70,600 in taxable income after your standard deduction. That puts married couples well into the 12% bracket, pushing toward 22%. Now, here's the second thing you need to know: required minimum distributions. Once you hit 73, used to be 72, they changed it in 2023. You have to start pulling money from your traditional IRA and 401k, whether you want to or not. The IRS wants their tax money. Your RMD is based on your account balance and your age. At 73, you're dividing your balance by 26.5. At 75, it's 24.6. The older you get, the more you have to take out. Let's say you're 73 with $400,000 in your IRA. Your RMD is about $15,094. That's added to all your other income. If you're already collecting Social Security and a pension, this RMD could push you into the next bracket. But here's what nobody tells you: you can control this. You don't have to wait until 73 to start pulling money out. If you retire at 62 and you're in a low tax bracket, maybe you're living off savings before Social Security kicks in. That's the time to do Roth conversions. You know, a lot of you have told me you get nervous when you have to call Social Security or Medicare. You're worried you'll forget to ask something important, or you'll say the wrong thing and mess up your benefits. So I put together something that makes it really simple. Word-for-word scripts for the 5 most common benefits calls. You literally just read from the script while you're on the phone. No memorizing, no stress. It covers everything: Social Security checks, Medicare extra help, appeals, all of it. It's in the pinned comment below if you want it. $5. You own it forever, and you'll never feel confused on one of those calls again. All right, let's keep going. A Roth conversion means you move money from your traditional IRA to a Roth IRA. You pay taxes now, but then that money grows tax-free forever. And it doesn't count toward your RMDs later. Here's the play: convert chunks of your IRA during low-income years, after you retire but before RMDs start. Fill up the 12% bracket. Don't go over into 22% unless you have to. If you're married and your taxable income is $70,000, you got about $26,950 of room left in the 12% bracket. Convert $26,000 from your IRA to your Roth. You'll pay 12% tax on it, about $3,120. But now that $26,000 grows tax-free, and you'll never pay RMDs on it. Do this every year from 62 to 72, and you could move $200,000 or more into your Roth, all at the 12% rate. Your future self at 80 taking big RMDs will thank you. Still with me? Because this next part is where retirees lose the most money. Third thing, Medicare IRMAA surcharges. IRMAA stands for Income-Related Monthly Adjustment Amount. Terrible name. Here's what it actually means. If you earn too much, you pay extra for Medicare Part B and Part D. For 2026, if you're single and your modified adjusted gross income is over $106,000, your Medicare premiums go up. For married couples, it's $212,000. The surcharges work in tiers. At the first tier, you pay about $70 extra per month per person for Part B. At the highest tier, over $500,000 for single filers, you're paying an extra $419 per person per month. Here's the trap. IRMAA is based on your income from 2 years ago. So your 2026 Medicare premiums are based on your 2024 tax return. If you had a one-time spike, sold a house, took a big IRA distribution, did a Roth conversion, you could get hit with IRMAA surcharges for the next 2 years. Real example. You're married, normally earn $150,000. In 2024, you sold some stock and had a $100,000 capital gain. Your income that year was $250,000. In 2026, Social Security looks at that return and says, "You're rich." Now you're both paying an extra $70 per person per month. That's $1,680 for the year. Even though your income is back to normal, you can appeal this if you had a life-changing event, retirement, divorce, loss of income. But most people don't know they can appeal, so they just pay it. The move here? If you're planning a big IRA withdrawal or selling assets, spread it over multiple years. Don't spike your income in 1 year and trigger IRMAA. Keep yourself under those thresholds. And if you do get hit with IRMAA, file Form SSA 44 to request a reduction. It's a 1-page form. You're showing Social Security that your income dropped. They'll adjust your premiums. All right, here are the 3 biggest mistakes I see people make with these new tax brackets. Mistake number 1, taking too much out of your IRA at once. You think, I need $50,000 for a new car, I'll just pull it all out. But that $50,000 gets added to your other income. If you're already collecting Social Security and a pension, that withdrawal could push you from the 12% bracket into the 22% bracket. You just paid an extra $5,000 in federal taxes, not to mention state taxes, because you took it all at once. Instead, spread big withdrawals over 2 or 3 years. Mistake number 2, not adjusting your tax withholding. Social Security withholds taxes if you ask them to, but most people don't set it up. Then they owe a huge tax bill in April. If you're in the 12% bracket and you're getting $2,000 a month from Social Security, have them withhold at least $240 a month. You can update this anytime by filing Form W-4V. It takes 5 minutes. Mistake number 3, ignoring state taxes. We're talking federal brackets here, but 41 states have income taxes too. Some states don't tax Social Security. Pennsylvania, Mississippi, others do. Some have flat rates. Some have brackets. If you're on the border between 2 states or thinking about moving, this matters. A $60,000 retirement income in Florida, 0 state tax. Same income in California, you're paying $1,800 or more in state income tax. Here's exactly what you need to do right now. First, pull up your 2024 tax return. Look at line 15. That's your taxable income. Compare it to the 2026 brackets I just showed you. Figure out which bracket you're actually in, not which bracket you think you're in, which one your real numbers put you in. Second, if you're taking RMDs or planning to, calculate what your income will be in 2026. Add up Social Security, pensions, IRA withdrawals, any part-time work. Does that push you into a higher bracket? If yes, look at ways to lower your taxable income, qualified charitable distributions, medical expenses, Roth conversions in earlier years. Third, check your tax withholding right now. If you're not having enough withheld from Social Security or your pension, you'll owe money in April. Better to adjust it now and break, even and get hit with a $3,000 tax bill you weren't expecting. Fourth, if you're anywhere near the IRMAA thresholds, $106,000 single, $212,000 married, run your numbers carefully before making any big financial moves. Selling a house? Doing a Roth conversion? Taking a big IRA distribution? Make sure you're not accidentally spiking your income and triggering 2 years of Medicare surcharges. Bottom line, the 2026 tax brackets went up about 2.8%, which helps a little. But if you're not paying attention to how your retirement income stacks up, you could still end up paying way more than you should. Run your numbers now, not in March when it's too late. The next video I'm doing breaks down the Social Security cost of living adjustment for 2026 and exactly how it affects your taxes. You're going to want to see that. Hit subscribe so you don't miss it. And if this cleared things up for you, drop a comment and let me know. What's your biggest tax worry in retirement? I make time to read every single one.